the dollar. It's feeling a bit of pain over this political shenanigans. Where do you see it going between now and the end of the year?
Yeah, I think, look, very short term, that what the market's doing is kind of counting the cost of, as you say, this political standoff that we've had. And so economists are revising down GDP. And against that kind of backdrop, it's going to be very hard for the dollar to make any kind of gains. The question is that thereafter, I think there is scope for some revival in the dollar, in part because of what's happening elsewhere. And perhaps we can talk about that later. But even from the US perspective, if you begin to get just some better numbers and you get through this distortion that we've had, then people might say, well, hold on, tapering's back on. At some point, tapering's back on the agenda, and ultimately that will be a dollar positive.
Well, we've got a slew of data coming next week. A lot of it's been postponed, especially payrolls, which are coming on Tuesday. What kind of effect do you think that's likely to have in the short term? And also, what's that going to have effect on tapering as well? Well,
look, these are vital elements because the Fed has made it clear everything is data contingent. Of course, we've had this vacuum for 16 days of no numbers. From the government at least. So yeah, it'll be very important. The problem, of course, is even if we get a very soft number, we'll say, oh, well, hold on, was that because of the shutdown? Has it been a distorted number, etc.? So perhaps there's a slightly greater significance if we get a good number. If we get a good number despite everything we've had, then it might just make the market wobble a little bit about this dollar sell-off that we've seen and kind of think, oh, hold on, maybe we should be buying a little bit back. So yeah, absolutely vital, particularly that payrolls number on Tuesday.
And how much of a concern is it as well if politicians can't broker a deal with the next couple of deadlines, January, February?
Yeah, I think from the market's perspective, we're having this cry wolf scenario, aren't we, where we feel we've been terrified about it at each instance, and each instance they seem to, at the last minute, come up with another solution. And kicking the can down the road isn't, of course, an ideal solution, but it is a solution. And I suspect we'll be at this point again in early January and ahead of the December deadline, where we're perhaps hopeful of a resolution, but not really expecting one. So again, I think the market should, I won't say relaxed, but I think we'll be pragmatic about how this plays out.
And just moving to the UK and to look at sterling, it seems to have had a pretty good summer, but do you think that this run is beginning to run out of steam?
Sterling's done very well. I mean, Sterling's done well because the UK has been doing better than expected. I won't say it's doing well, it's doing better than expected. But also because, frankly, it seemed the best of a bad lot. You know, it's actually enjoyed support. It's behaved a bit like a safe haven, which in many respects is a worry. If that's the best we've got, then we really are in trouble. I think it's vulnerable because we've built in a lot of rate hikes into the UK expectations. And to feed that, support that, you need to continue to get reasonable data. And occasionally we get these downside surprises, retail sales, manufacturing production, and sterling comes off very sharply whenever we've had that. I think that's still the vulnerability into year end.